Watch what happens to this physical money over a few short years. This visual represents a mathematical certainty. If you leave your savings sitting in a standard bank account, it is actively shrinking in physical size and purchasing power. Financial professionals call this cash drag. Because average inflation consistently hovers between 3 and 6%, keeping 100% of your wealth in cash mathematically guarantees you will lose your ability to buy the same goods tomorrow that you can afford today. This split comparison graph tracks a $10,000 baseline over a 10-year period. The bottom line shows that cash losing its value to inflation, while the top line tracks the exact same $10,000 deployed into a standard index fund. Look at the 5 and 10-year markers. You can actually visualize the opportunity cost of doing nothing. That shaded area is missing wealth, capital you permanently sacrificed by staying on the sidelines. To bridge that gap, you need an asset. In practical terms, an asset is simply a system or vehicle that generates financial value independent of your direct hourly physical labor. But if you look online today, you are immediately hit with decision paralysis. You will find gurus pushing 10 different assets at you simultaneously. Everything from buying physical gold, to flipping real estate, to launching a faceless YouTube channel. Attempting to pursue all of these options at once leads to failure. They demand entirely different types of personal resources to get off the ground. Building wealth requires a specific match. You have to identify the single asset class that aligns with your current constraints of time and capital. Every investor has a fixed budget of 2 foundational resources: upfront capital and available time. We can map every wealth-building option on this quadrant chart. Across the bottom, required capital. Up the side, time and effort. Let's start with traditional passives. Watch these icons drop into the high capital, low time corner: mutual funds, SIPs, stocks, and gold. To make this category work, your required input is a consistent allocation of cash over 10, 20, or 30 years. In exchange, your daily operational effort is practically zero. The outcome is reliable. Over decades, compounding interest does the heavy lifting, growing your money while you sleep. But here is the trade-off. These assets have a slow growth velocity. A mutual fund will not take you from zero to a millionaire overnight. Traditional passives act as defensive wealth multipliers. They are designed to protect and grow money you have already earned, rather than create initial wealth from scratch. Next, we look at vehicles that use financial leverage to create multiple streams of return simultaneously. Look back at the chart. Real estate lands in a unique spot: high capital but moderate time. The inputs here are steep. You need either upfront cash, or you must take on debt through a mortgage. On top of that, you are committing ongoing time to property management. The advantage is a dual outcome return. You capture the long-term appreciation of the property's value while collecting immediate monthly cash flow from rent. The primary trade-off is extreme illiquidity. Your money is trapped in the concrete. And if you mismanage your tenants, maintenance costs and vacancies will quickly turn that asset into a cash-draining liability. Real estate is a powerful hybrid, but it requires a much higher risk tolerance and operational capacity than buying a simple index fund. What if you are watching this without thousands of dollars to deploy? That brings us to the digital economy. On the framework, digital assets fall into the extreme low capital, high time quadrant. Think e-commerce stores or faceless YouTube channels. The true input reality for these vehicles is hundreds of hours of uncompensated active labor, market research, and sweat equity. You are building the machine from scratch. If you succeed, the outcome is highly scalable, outsized cash flow. Eventually, with enough revenue, you can hire a team and automate the process. The trade-off is a massive failure rate. Despite how they are aggressively hyped online, these are active, demanding businesses. Do not treat a digital business like a passive investment. Until you find market traction, you are effectively working for free. Digital assets are the equalizer for anyone with an empty bank account. You are simply trading your immediate free time for the potential of future cash flow. To move into any of these investment categories, you first need a reliable way to generate the initial capital. For our final quadrant, we map high-income skills like coding, sales, or copywriting right at the edge of low capital and extremely high time. The input here is intense, focused discipline. You are spending your evenings and weekends learning and executing high-leverage abilities that the market values. The outcome is a drastic and immediate increase in your primary earning power. The trade-off is straightforward. This is active labor. You are still trading your time for money. Mastering a high-income skill provides the cash flow engine necessary to fund the long-term passive investments we've discussed. If you try to learn coding, buy real estate, start a YouTube channel, and day trade stocks all in the same month, you will dilute your capital and burn out. You have to pick a lane. Let's look at this decision tree to find your exact starting point based on reality. The root node asks one question: what is your primary constraint? If you are a professional working 40 hours a week with surplus cash, follow the path on the left to the limited time steady income node. Your directive is strict. Ignore the hype around side hustles. Prioritize automating your income directly into SIPs, mutual funds, and established stocks. Conversely, if you are a student or a young professional, trace the right path. You land on abundant time, limited capital. Stop obsessing over making a 10% return in the stock market on a tiny principal. Your directive is to deploy your free hours into building a digital asset or acquiring a high-income skill. The entire ecosystem connects. Your goal is to use the heavy cash generated by those active skills on the right to eventually fund the passive investment vehicles on the left. Financial success relies on auditing your current resources and systematically converting your active labor into permanent assets.